Hello everyone, welcome to Lineup Stocks. I'm Will. Today is March 28th. I will provide a detailed analysis of the current market landscape, share my views on the war and inflation, and finally explain why TLT represents the best investment opportunity right now. The US and Israel have launched heavy airstrikes directly targeting Iran's nuclear facilities, missile bases, and underground military bunkers. In return, Iran has fought back hard. They have fired hundreds of suicide drones and ballistic missiles at Israeli cities and U.S. military bases in the Middle East. This conflict is shaking the global economy, causing oil prices to jump. But more importantly, experts warn that this war will not end anytime soon. Both sides are refusing to step back. The anger is deep, and a quick ceasefire seems almost impossible right now. We are looking at a long and painful fight. The US did offer a 15-point peace plan, asking Iran to give up its nuclear program completely, but Iran says the plan is totally unfair. With no deal in sight, the whole world is watching nervously. I think as long as oil and ships aren't passing through the Strait of Hormuz, there will still be a lot of uncertainty. And Iran has said it wants a full end to the war. Right now, we are seeing a massive signal in the stock market. U.S. market valuations seem to have hit rock bottom. If we look at the forward P/E ratio, which compares stock prices to expected future earnings, the market is incredibly cheap. In fact, the valuations for many massive large cap companies have dropped all the way back to the absolute lowest levels we saw during the market bottom in April of last year. All the fear and panic have pushed prices down, meaning the market is already pricing in the worst case scenario. For long-term investors, this could be a historic moment. War issue needs to be resolved by early April. If it drags on for a really long time, say a few months, oil prices are completely unprepared for it. If they aren't prepared, PCE personal consumption expenditures inflation could jump over 5% and core PCE to 3%. If that happens, the US economy will fall into a recession. This is a very serious situation, and it's something the capital markets have absolutely not priced in yet. In the current market, because of the war in Iran, I think the market is focusing way too much on inflation when pricing interest rates. This is exactly why we will talk later about what to do when investing, like how to act when trying to buy the dip. The reason the market is pricing in too much inflation is that we are seeing the 10-year Treasury yield go above 4.3%, right? And short-term rates are all running up right now. Many investment banks even think there might be no rate cuts this year. Some even think there will be rate hikes. Honestly, I think the chances of a rate hike are very slim, because the risks for everyone would be massive. Some banks strongly believe there won't be rate cuts this year, but I think not cutting rates and the market pricing in rate hikes are two totally different things. My view on not cutting rates is based on my analysis of whether inflation will cause an economic recession. But a rate hike is impossible as long as President Trump is in office. His biggest wish is to cut interest rates. We can look back at the first Gulf War in 1990. Back then, the Federal Reserve basically kept interest rates flat. They didn't move them, but they had room to cut beforehand. So right before the crisis hit, they cut rates once and then just let them float. In 1990, oil prices were pushed way up for quite a long time because Iraq set those oil wells on fire. Why do I fundamentally believe there isn't real inflation right now? Or that the inflation problem isn't that severe? Because when the Fed has to choose between fighting inflation and protecting growth, history shows they always side with economic growth. Always. So, from this perspective, around September or the third quarter of this year, after the impacts of previous tariffs have completely faded, we will likely see the unemployment rate climb above 4.6%. Once unemployment rises above 4.6%, the Fed's attitude will lean much more toward protecting jobs. And frankly, I believe their eyes are already on the job market right now. Even if oil prices are high at that time, and even if CPI is high, I don't think a rate hike is possible because economic growth is the absolute core priority. This is very different from the inflation we saw in 2022 after the Russia-Ukraine crisis. The root cause right now is not a supply chain shortage. It's not what we call a wage price spiral. It's not a labor shortage or a general lack of supply. Back then, they handed out a lot of money and printed money for a long time, which caused inflation to explode all at once. But that's not the case now. This is a one-time event, a one-time war causing a spike in energy prices. So its impact on sustainable inflation isn't actually that big. I think its bigger impact will be in the opposite direction. It will eventually hurt economic growth, and that negative impact will be much stronger. I feel the market will eventually trade in that direction. If the worst case scenario happens, we will first see an oil panic or oil crisis. People will be terrified of rising oil prices and rising inflation, which will crush risk assets. Long-duration bonds and stocks will both fall, which is exactly what is happening now, a double drop in stocks and bonds. We saw this double drop just last week. After stocks and bonds fall together, we will enter a recession. People will start worrying that GDP growth will fall below 2%, and they will worry about a US recession. Even if oil prices are still high at that point, the fear of recession will take over. Right now, the US 20-year Treasury yield has reached a terrifying 5.0%, and the 10-year Treasury yield has also hit 4.4%, which is a recent high. This is something that most people are completely ignoring at the moment. If you look at global currencies recently, the US dollar is acting the strongest. The war hasn't stopped the dollar from staying incredibly resilient. So, how high will the dollar go? But looking back at the big picture, the US will still face the impact of a recession. Even though it might be the least affected globally, the recession impact is still coming. And under the weight of a recession, interest rates naturally have to go down. Actually, since the beginning of the year, we've felt that interest rates are a very easy target to trade. So, this brings me to the absolute most important point of this video. When we're at the bottom of the market and you are afraid to buy, first ask yourself, do you dare to buy bonds? Do you dare to buy TLT or the 3x leveraged long TLT? If you don't even dare to buy that, then you definitely shouldn't be buying stocks. Stocks are risk assets. Ultimately, you still have to wait for the second heavy blow to economic growth, what we call the second wave, the recession, which hasn't arrived yet. The worst case scenario, the recession or the real economic downturn, hasn't fully hit us. But of course, as we saw yesterday, bonds and interest rates will eventually come down. If you truly believe the US-Iran war is going to be resolved immediately, then sure, you can just go straight in and buy stocks. But if you think there is still a massive crisis ahead, meaning the consensus is that this war will drag on for a much longer time, then it all ultimately depends on how the negotiations with Iran play out. Will they reach a deal, or will it fall apart? We don't know. I believe most people don't know. I think even President Trump doesn't know. He's still working on it. So if you take a chance and just go all in on a trade based on this, I think the risk is extremely high because politics are just too hard to predict. Trump has tried to negotiate and talk this over many times, and I believe he really wants to put a quick end to this war. Why do I think this? Because as a Chinese stock trader, I know deeply how much Trump wants to bring this victory with him on a visit to China. This trip was negotiated as early as 3 months ago and was originally scheduled for early April, but now it has been delayed. Why? Personally, I think it's because Trump currently has no clear expectation of when the war will actually end. That is exactly why we are seeing the stock market jumping up and down lately, with daily swings of over 1%. But in the last 2 days, the sell-off has accelerated. I think there are 3 reasons for this. First, it's the end of the month effect. Liquidity is shrinking. Plus, there is the CTA fund selling that I've been warning you about in my previous videos. Second, the market is starting to price in a prolonged war. And third, capital has already started pricing in a recession. So, all in all, it is incredibly difficult to trade right now. I am probably one of the very few people on YouTube advising everyone to reduce your positions and stop trading. Maybe us stocks will see a bounce next week, but the risks are still massive. You guys can pay attention to the market weather forecast at the end of my video, but I firmly believe that under the current circumstances, TLT should be the best midterm asset to hold. Okay, this is Lineup Stock. See you next time.